with today's webinar, which is on making, I guess, using best accounting practices for those who have received a PPP loan. And thank you again for taking the time to put this presentation together for the Mount Pleasant Chamber.
Sure, glad to do it. So yes,
Great.
as you mentioned, we're going to talk about the Paycheck Protection Program.
Right. And tell me a little bit about your background while folks are logging in.
Sure, since people are still logging in, so I'm the managing partner, CPA with Legare, Bailey, and Hinske here in Mount Pleasant. We're an accounting firm with 9 CPAs and 11 total staff. So for Charleston, kind of a larger firm, work extensively in the tax planning, consulting, and preparation industry, a lot of business consulting, which in the past 2 months, we've made a major pivot towards this business consulting piece, mainly because of the stimulus programs that have come in. So it's kind of been what we call the never-ending tax season, because the April 15th due date again has been moved to July 15th, and we've got all this new regulations coming through and these new programs and working with businesses to try and get them cash flow and funding and decision making on what to do going forward. So it's been a very taxing time.
So you've been just a little busy?
Unintended, as
You've
well
just been
as,
a little busy?
We've been just a little busy. So trying to get our arms around these rules that are changed almost every day. We're coming up on the first batch of loans to be at the end of their period to achieve forgiveness. So really trying to look at, what regulations and rules are coming out, as well as what, the newer rounds of people can do to, make sure they're maximizing the use of these funds to really be a benefit to their business and employees and customers.
Well, thank you so much again for your time and today sharing your time and your expertise with the Mount Pleasant Chamber of Commerce, all that you do for us, also as treasurer and a very, very active board member. I'll let you go ahead and get started. I am going to run your slides for you today, so I'll do my best to do those in a timely manner and anticipate when you need me to move forward, but we'll go ahead and get started. I'm going to mute my mic.
Okay. And so again, we're going to talk about the Paycheck Protection Program and the forgiveness aspect of it. So we're not going to talk about applications are done, although there's still some money available. You still could apply if you haven't, but we're going to go under the assumption that we've already received the money and now go through the rules for the forgiveness portion. So next slide, any presentation we give, we have to give a disclaimer that, tax advice is our communication. Don't rely on this, but this is really some pointers and questions to be able to ask your accountant. The most important point of this slide is the very last 3 words, that it's as of May 25th, 2020, mainly because these rules are changing almost every day. So you want to make sure that anything we point out, that you're getting the most relevant and timely information. As we go, this was a very kind of hard thing to put into a presentation. So if you'll follow me here, we're again talking about the forgiveness of the PPP. So this goes through forgives the portion of the loan, and then each color is a different portion of tests that we need to meet. So we forgive a portion of the loan for eligible costs, which we'll talk about, that are incurred and or paid, which is a totally different thing among itself, during the covered period while maintaining an employee. So each of these 4 colored items we're going to go through in a little bit of detail so you kind of understand it. But that's kind of what we're talking about. These eligible costs, when are they paid and incurred, what's the covered period, and what does it mean by maintaining our level of employees. So as we go into the first eligible cost, the biggest piece of this and what the loan was really majorly intended for is payroll. So again, this loan is to try and have knowing that we've got a downturn, maybe we're closed altogether, maybe we're at reduced capacity, but the intent was to keep people employed on our payroll until we could fully open back up. So the payroll costs that are eligible are our gross payroll to all employees that are non-owners, and it gross payrolls before any withholding for their Social Security, their income taxes. If you're withholding any kind of expense, this is the gross paid. So if their salary's $60,000 a year, we're basing that $60,000 as their gross payroll. We're limiting it to $100,000 per employee per year. So if somebody makes more than $100,000 for the year, they're going to be counted as if they make $100,000 a year for this period. Any excess doesn't count. So they're not totally excluded, but only that $15,384 of payroll. That would be 8 weeks, as we'll talk about. That's kind of what's going to count for that employee over 100. In addition to gross payroll, it's the retirement contributions of the employer. So if you have a 401k and the employer does a match, that match piece is what we're talking about for that. The employer paid health insurance contributions. So again, if the employer pays all of the employee's health insurance accounts, maybe if they pay 70%, the employee pays 30%, that's 70% that the employer is paying is going to count. And then state unemployment premium. So here in South Carolina, we have the SUTA, state unemployment, whatever that is for those employees' payroll for that period is going to also count towards payroll. And then we get to, I said the gross payroll for employees that aren't owners, the owners are limited. So if we go to the next slide, we'll see what the employer limitation is. So one of the immediate thoughts of workaround was, we can just pay the owners whatever we want, and that'll get us the maximum forgiveness. But again, we're limited to $100,000 per owner per year, or 8/52 of their 2019 pay, whichever is lower. So if your owner last year only made $60,000, then you're only taking 8/52 of that $60,000 is the most that you can pay the owner and exclude. Again, then we're talking about what gets excluded. You can pay anything above $100,000, but you only get to count exclusion up to the $100,000. So this either or amount for owners is kind of the safe gap bonus, all the money out to the owners and get forgiveness. If you're a self-employed owner, it works somewhat the same way. It's going to take 8/52 of your 2019 net Schedule C self-employment compensation. So that's kind of where that piece comes in. If you're self-employed as well, again, we talked on the previous slide, any employee health insurance and retirement costs count. So that would have to be for a business with owner, that would have to be an S corporation where the owner is an employee. If you're a partnership or a sole proprietorship, then your retirement and health insurance costs do not count as part of the exclusion items. And if you think about your tax return as a self-employed or partner, those expenses are deductible, but they're just not deductible against business income. So again, this is trying to get to what would the business deduct? That's what we're going to count as payroll. So that's the first big category is payroll costs. So those are eligible payroll costs. Then we get into these other costs. The other costs are rent, defined as real or personal property rent with lease agreements in force before 2/15 of 20. So February 15th of 2020 is where they're drawing the line to say, if you don't, if you rented something after that, you don't get to count those rent payments. Same thing with number 2, the mortgage interest paid. It's got to have been on a business mortgage obligation incurred prior to 2/15 of 20. So if your business went out and bought its real estate that it is using in the business, it's got a loan. If that was done before 2/15 of 20, then you would be able to count the interest payment during the eligible period for forgiveness. And then the third category there is utilities, which they define as business utilities with service that began prior to 2/15 of 20. So if you changed your internet provider in March, you won't get to count those expenses there anyway. They're from there. All right, if we go to the next one, we'll talk about what utilities qualify. And there was a question about the periods, which we'll get to. So I'm going to answer that question in just a few minutes when we talk about the period. So we're talking about the cost. Utilities, we've got, and again, this is from there, from the Small Business Association and Treasury Department. What counts as utilities? It's electric and gas, water and sewer, transportation, which we don't know what that means yet, telephone and internet. Those are the 5 categories they listed. We know right now that those count. And you know, a lot of questions we're getting, well, what does transportation mean? We don't know. If we pay an auto allowance to our employee, does that get to count? And right now I would say I wouldn't bank on that counting. You know, we don't know what transportation means, if it's just reimbursement of, you know, business mileage for that period. So that one, you know, we've got no guidance on that. But a lot of the questions we're getting, well, what about, you know, and, you know, if we're a restaurant, we have to pay separate trash and recycling. Does that count? That's, you know, typically in accounting world, that's a utility in our, you know, in our mind is a utility for this. We don't know. They first tried to defer to the lenders and say it's up to your lender. The lenders kicked back and say, no, you're writing the rules. You need to write the rules. So, you know, we're expecting some guidance from Treasury on a little more of these. Again, the transportation especially, and then any other utilities other than these on what would count. So let's see, you know, so we kind of talked about the specific costs that count. So now let's talk back up and look a little more general. So we're going to talk about that what we talked about payroll costs, which remember included the benefits. That must be 75% or more of the forgiveness total. And then our other costs cannot exceed 25% of the forgiveness total. So really the first thing is, once we know what our payroll costs are going to be during this period, we basically divide it by 3. And that's going to be what the maximum other cost we can get forgiven. There were a lot of questions of, well, what if my rent exceeds the 25%? Do I lose all forgiveness? And the answer is no, you don't lose the forgiveness. You lose the forgiveness or the eligibility forgiveness on anything above the 25%. So if rent comes out to 50% and payroll's 50%, we're going to exclude all the payroll, and we're going to exclude half of the rent under, or a third of the rent under that computation. So you don't lose if you have too many costs. They're just only what can maximum amount that can count for forgiveness. All right, so that's our first piece. So again, we said there were 4 different pieces. So first is eligible cost, and then it's incurred and or paid. So what does that mean? Well, we take our eligible cost, and then that are either paid during the covered period, which again is our third category we'll talk about. So just in your mind, think paid during the covered period, or that are incurred during the covered period and paid on or before the next billing cycle. So again, we're paying it during the covered period, or we incurred it during the covered period and we're paid on the normal due date, which just happens to fall outside our billing cycle. And if I've lost you, we'll go to the next slide and I'm going to give you an example that'll hopefully clear it up. So we've got a covered period. And again, we're going to define what that means. But for this example, we're going to assume that our covered period is the 8 weeks that run from May the 5th to June 29th. So that's an 8-week period. We pay our electric bill for April on 5/12, the normal due date. We pay our electric bill for May on 6/12. And then we pay our June's electric bill on 7/12. So those are the normal due dates. It's due on the 12th for the previous month. What counts for forgiveness? The fact that with tax law, one of the first things we're taught is to read the words, and that words mean a lot. So the fact that it's incurred and/or makes a big difference than if it was just and or. So that makes a difference to say that the amount forgiven is actually our April bill, our May bill, and the pro rata portion of June's bill. So if our bill runs from June 1st to June 30th, and we pay it on 7/12, we would get to count 29/30th of that last bill, giving us almost 3 months worth of utilities that would be eligible for forgiveness. So when it first came out, everything was 8 weeks. It's 8 weeks, and you're going to have to do all these, calculations and accounting differences to figure out, oh, you've got 5 days of this bill and this month and 30 days, and then, or how many weeks? No, they've said if it's paid during this covered period and it's paid in its normal date that's after, but it's for service during that period, it counts. So again, in this example, we're almost getting 3 full months of utilities that are going to count towards forgiveness. So it's a very generous application of that rule in terms of we're not having to break out when we pay it. The amount on here, so if we think about rent and say, okay, well, this is rent. Say, okay, well, if rent was the same thing, under the same thing, a lot of rent though is prepaid, meaning you maybe pay on the first of the month for that month. So in this case, if we were to cut June, we wouldn't be able to count July 1st rent payment because that's for the period of July 1st to July 31st. So we can't prepay an expense. It's got to be incurred during this time and then paid after at its normal time. So if we paid rent in arrears, we would get to count it. So if you've not paid March's rent or April's rent yet, and you're still in your covered period, the rule would seem to be that if you paid it now and caught it up, you would get to count it. Payroll's a little different. We'll talk about payroll in a minute. So this is for those kind of other costs. So I hope that makes sense. Again, it is a rather beneficial to the borrower business, a beneficial interpretation of the rule. Again, and this came from Treasury, so this is how they're interpreting, even though I don't think that was the intent. But so now we've talked about covered cost. We've talked about what incurred and paid means. So now let's talk about what our covered period is. So all along the covered period is the 8 weeks, right? The 8 weeks begin whatever day the money hits the bank account. So the eligible costs incurred and or paid during these 8 weeks are eligible for forgiveness. So again, I put an example there. We got our funds on Tuesday, May the 5th of 2020. Our 8 weeks, and again, you pull out a calendar and count weeks. It goes from Tuesday, 5/5, the date the funds were in the bank, to Monday, 6/29. So that's our 8 weeks. It's 56 days, runs from that to, from a Tuesday to Monday in this example. And they said, well, that sounds very confusing. Again, for our other costs, we can kind of massage that. That makes sense. But for payroll, that gets kind of confusing. So they've added, and again, this was in none of the all the original information was you get 8 weeks from the date you get the money. As the application came out on the 15th of this month, was adding this alternate payroll covered period. So again, the covered period here, the 8 weeks to start on the date you get the money, only applies to the other costs. The alternate payroll covered period, which is the next slide, will show that we can elect to treat this period, the alternate period, for our payroll costs. So we can do payroll under the covered period, the 8 weeks from the date funding, or this alternative, which says, look at when you get your funding, but your timeline for payroll begins the pay period after the funds are received. Again, and this is if you're bi-weekly or more current. So bi-weekly, where you pay every 2 weeks, or if you're a weekly payroll. So again, we'll take our prior example. Funds are deposited in the bank on May the 5th. Our next payroll, which is bi-weekly, starts on May the 11th. So then it would be, again, every 2 weeks, it would be May 11th to actually July the 5th would be our paid periods that we could cover under this alternative payroll covered period. So that, so that gives us kind of a thing of, oh, maybe we didn't have people on the 5th, or more importantly, breaking out the payroll to say, oh, that's our funding date was in the middle of our pay period. And now I got to figure out how many days were on that period, how many days were on the other. So in this case, let's say that our cutoff is for payroll is Sunday, July the 5th, and we give checks out that next Friday. That's our normal schedule. Those checks paid on Friday, July I think that would be the 10th or something like that. That Friday, after the end of our period, those would count, even though now they're paid, 5 full days after the end of our test period, because that's our normal pay cycle. So you say, oh, well, we're on a twice a month payroll, we're semi-monthly. So we get checks on the 15th and the 30th. Then you'd have to look to see when you lined up, because then possibly you would have to split payroll. So again, in our example, if we were the regular payroll, you might end on the 6/29 date. You might say, okay, well, that's close enough to the end of the month. We'll count that one and just back off a day of that pay period to kind of make it work. But again, we could go to this bi-weekly payroll. We've had a couple clients that were either monthly or semi-monthly that are actually going to a bi-weekly payroll for this period just to make their process easier. And then they may switch back to semi-monthly. They may stay on bi-weekly. It kind of depends there once we get through this forgiveness period. And it is, again, I just want to reiterate, and I think this is answering a couple of the questions. It is weeks, 8 weeks. So it's not month where we can say, oh, we got our check here deposited on 5/5, so we get to go through 6/5 and 7/5. It's weeks. So we've got to actually look at the weeks, not the months. So it's not 2 months, which I think they did themselves by confusing to make the funding based on 2.5 months of cost. The forgiveness is based on weeks, not months. So we need to make sure we're looking at the actual weeks and days, not months. So again, for the payroll, we've got to look at what our normal payroll is. If we're monthly, then if we're going to stick with monthly, we're not eligible to use this alternative payroll covered period, because we have to be paying bi-weekly or quicker. So basically, you've only got 2 choices: to pay every week or to pay every 2 weeks. If you're monthly, semi-monthly, if you have some other kind of hybrid method where maybe part of their payroll is bi-weekly, and then there's monthly commission checks that are the end of the month, you're going to have to look at that and maybe change what gets paid during this timeline to make sure it qualifies. Again, more guidance is going to be issued on some of those, especially now that they've said it's only eligible for bi-weekly or quicker, to say, if you're semi-monthly, here's what you can do. Or if you've got, quarterly bonuses, here's how you can count those quarterly bonuses, where maybe a proration gets clawed back into your forgiveness calculation. So if you have any kind of special payroll, you may want to make sure you kind of keep an eye on what's going on there with this alternative payroll period and what you can count. Again, the frustrating part is we're coming up on the end of forgiveness periods, and we don't know all the rules yet, because they're kind of changing as we evolve. All right, so the last piece is that we have to maintain our level of employment. So now we've got, again, we've counted our covered cost during our period, what's paid and incurred, and now what our covered period actually is. So then we say, okay, that's calculation is kind of our maximum forgiveness, but now is there a necessity for us to reduce what can be forgiven? And that's if we don't maintain our employment levels. So for the full-time equivalents, we reduce our forgiveness amount if we've reduced the number of full-time equivalents or we've reduced people's pay. All right, two very big areas. So let's talk about each one in a little more detail. First thing we have to do is calculate our full-time equivalents. Now, some people say, oh, full-time equivalents, I understand that. That goes back to when we have to mandate having health coverage provided by the employer. And next slide shows that the calculation of these full-time equivalents is a different calculation from our calculation for health insurance. Health insurance full-time equivalent was based on a 30-hour work week. For these purposes, it's defined as 40 hours. So basically, we take the average number of hours worked per week in 4 different periods that we'll talk about in a second. Divide by 40, round to the nearest 10th, right? So we'd look at everybody, what are they working every week? 40 is the maximum. If somebody works more than 40, they only get to count as 40. Or we can use, they said that, seems a lot. We'll use a safe harbor. If the person is normally working 40 or more hours a week, typically, you count them as 1. If they typically work less than 40, you can count them as 1/2. So you have 2 employees that only work 30 hours a week. Together, even though that's 60 hours, safe harbor, they count as 1. So in the other one, they would count as actually 1.5 because they'd each be 0.75. So rounded to the nearest 10 is 0.8. So you would have actually 1.6 employees under the actual calculation. Under the safe harbor, you'd have 1.0. So, I think a lot of places, especially if you have wide fluctuations in part-time employees, you're just going to use the safe harbor and count everybody at 1/2 if they're not typically, hourly and less than 40 on an average week. So again, I think a lot are going to be using the safe harbor. And on the next slide, we'll see why, because we have to calculate 4 different periods of what those full-time equivalent employees are. So we're going to look at from February 15th of 2019 to June 30th of 2019 and calculate how many full-time equivalent employees we have. Then we're going to calculate from January 1st of 20 to 2/29 of 20, say how many full-time equivalent employees we have. So that 1 or 2, whichever we choose as the employer, so we calculate both, and if one's a little bit lower, we might want to take the lower one. That's going to give us the baseline that we have to meet in 3 and 4. So again, we pick which one of 1 or 2 we want to use, and then we look at 3 and 4. 3 is the end of the date of the covered period. So again, if I go back to our previous example, it's 6/29. So in this case, there wouldn't be a big difference. But some of the people that are approaching forgiveness now, they added in this June 30th date to say, oh, maybe you didn't get everybody back to work at the end of your 8 weeks because you weren't fully open. We'll give you to June 30th to get there. So if your baseline from number 1 and number 2, if that's the same or lower than number 3 or 4, then you don't have to reduce forgiveness by reducing the number of employment. There is special rules if you're a seasonal employer. If you weren't open in 2019 for part of the year, let's say you weren't open until, if it's after June 30th of 19, you didn't open, you would only use the January through February 29th. If you happen to be lucky enough to open sometime, let's say February 1st, then you would only count February 1st to February 29th in those average full-time. So it's the average full-time equivalents during that period. So if, February you have lower count, February 19, you added people by the time of June of 19, it would have been the average that you employed during that period. So that's kind of how we calculate our full-time equivalents. So let's say one of the big questions we got is, oh, well, my people are on unemployment and now they don't want to come back to work. Or maybe one of my employees has small children, her daycare is not reopened, she's got no childcare opportunities, she doesn't want to come back to work yet, she's unable to come back to work yet. So our next slide, kind of they built in that I guess, opportunity for that to have happened and not hurt the employer. So as the employer, as long as we make a good faith written offer to rehire that employee during our covered 8-week period, it's got to be a similar job, similar pay. If the employee rejected that offer to come back, they don't count. So let's say I had a person that worked with me all of 2019, right? So they would have been a full-time. So they were a full-time employee for my baseline period, but now they're no longer employed. Do I have to run out and find somebody to take their job? And the answer is no. If we tried to hire them back and they declined, we don't count them from 2019 and we don't count them in our covered period. So it's as if that person, so we would reduce our full-time equivalents by anybody that doesn't come back that we've offered to. If for some reason we fired somebody for cause, or they quit, or they voluntarily requested to work less, maybe they say, you know what, I can't do full-time, I can only do 20 hours a week, then we get to count them from, again, our baseline as a half a full-time equivalent, and then we've hired back that half full-time equivalent. So even if we haven't replaced them. Now, if we have replaced them, which is number 3, if we have replaced them, then we have to count them in the baseline. So if you say, oh, well, John quit, but I hired Fred to take his spot, then we have to count John in from last year so we can count Fred in for this year in the full-time equivalent. So these are only people you haven't replaced. So you don't have to worry about the employer getting dinged if somebody didn't want to come back. Now, the rules are, if you've offered somebody back that offer a similar job at similar pay and they reject it, then you have to notify unemployment that this person is no longer, they're voluntarily unemployed and could reduce their unemployment benefits because they did not come back to work. So that's kind of the thing. Now, if there's some reason where you're not bringing everybody back, then that's a different situation. So if it's this person's job's not really reinstated yet, maybe they're the hostess at the restaurant and you're not bringing back hostesses yet because you're limited to the number of people, so you're going to manage that with the serving staff, then that person, if their primary role was a hostess, then they could stay on unemployment because you have not offered them their job back. They would still count towards your full-time equivalents from before, but there may be a business reason not to bring everybody back on payroll yet. Again, with the safe harbor, if everybody's hours are reduced, there's no test for that if we're using the safe harbor equivalent, that anybody working part-time is counted as a half. Then I may have a job share where I had 2 half-time people at 30 hours a week that are now only working 20 hours a week each. They still would count for the safe harbor method as a half of employee. So what happens if, let's say, some people, were not able to hire everybody back? And so in my example, I'm not bringing back my hostesses. So now I'm down a couple of full-time equivalents. So the next slide shows that we just do a Prorata reduction. So again, at this example, we had 20 full-time equivalents during those 2 testing periods. So that's our baseline of 20. At the end of our covered period, which is again the end of our 8 weeks or June 30th, we only ended up with 18. then we only get forgiveness of 18/20, so we would lose 20% of all our covered costs once we calculated what qualified to say, okay, that's our maximum forgiveness. Now we have to reduce that by 10% because we didn't maintain our payroll for the same level as we had pre-outbreak. So it's not an all or nothing thing, it's just a pro-rata reduction. And again, anybody that doesn't want to come back because of their own purpose that we offered to come back doesn't count. Okay, next slide talks about the second part of that calculation was a reduction in pay. So maybe you've got all salary people and you said, okay, we're going to bring everybody back, but everybody's going to get a pay cut. And we're going to reduce everybody by 30%. So if we reduce pay by more than 25%, then we reduce the forgiveness amount. So again, this one's a little harder calculation because we're allowed to reduce everybody by 25%. So in an example, my pre-COVID pay was $1,000 for the week. By the end of our covered period, I'm only paying you $700 a week. So my reduction in forgiveness for the 8-week period is $800, which is, again, I show the calculation. I reduced your pay $300 a week. I was allowed to reduce it 25%, $250. So I reduced it more than allowed by $50 for all 8 weeks. It's $400. So if in our loan we were able to come up and meet every other test and we were able to get forgiveness of $100,000, we would now get forgiveness of $99,600 because we'd have to reduce it by this $400. This is per employee. So if I had 10 employees and they're all the same, then I'd reduce it by $4,000. So again, it's not an all or nothing thing, which some of the original thoughts were, oh my goodness, this is going to be all or nothing. Then I'm not going to meet it. I'm not going to get any forgiveness. That's not the case. Again, it's all pro rata. So these requirements are pro rata. Let's see. Okay. Next slide, just got some other things, which there's a couple other things I don't have listed there, but I'll run through these first and then answer some, which I think were maybe in a few of the questions. The forgiveness amount is reduced by our EIDL, the disaster loan advance payment. So if you remember when all this happened, first thing they threw out was you can apply for these disaster loans. Then they made the grant up to $10,000 of this loan could be a grant that would need to be paid back, and then any additional is a loan. Well, if you got any of that $10,000, and it ended up being basically $1,000 per employee is what they paid out up to 10. So if you had more than 10 employees, you got 10,000. If you had 5 employees, you maybe got 5,000. Again, if we met every other test and we spent our total loan on all qualified costs all during the period, we met every test we talked about, and we got a $10,000 advance, $10,000 does not get forgiven. So again, we'd have to pay that back or that's a loan. So even if we did everything right, the fact that we got this advance payment, they're considering that an advance on the loan that's unforgivable. So even if we spend more than our loan, we don't get to reduce the forgiveness by this advance payment. There was a big, when the first round, you remember this was funded in 2 different rounds. The first round seemed to go to some publicly traded companies, some large companies with multi-locations like Ruth Chris. I know the Los Angeles Lakers ended up getting a loan, all this other stuff. And they said, oh, now we're going to second round. You're going to have to prove that you needed the money. So you either had business loss, you were closed, you had no money coming in, you had no other eligible funds to be able to fund you. If the loan is under $2 million, you're safe harbor that you don't need to prove that you needed this money, only that you spent it the way it was supposed to be spent. So, you could have had $2 million in the bank and got $1 million loan and paid out $1 million. They're not going to question you, why didn't you use the money in the bank? So as long as the loan's under $2 million, you're automatically deemed to assume that you needed it. There are some again, in the application or in the forgiveness application, which again, it's funny they call it a forgiveness application because you're applying to be forgiven even though you've met all their tests. There's several certifications you need to do that, you know, this money was spent like it was needed, like it was supposed to be spent, that you have documentation to back all this up. We'll talk about that. And the main thing is that the responsible party is initialing each one of these statements, and there's about 10 of them, to basically put you personally on the hook if they find that you were doing something fraudulent. Seen they've made about a dozen arrests so far of people getting this money and then using it on other things, or falsifying documentation and saying they had employees that they didn't. So they're already looking at this already. So this is a way to kind of get you personally on the hook for this if you're not doing it. A couple other things I thought as we were kind of running through this was, again, if you're a newer business, and we talked about the full-time equivalent, there's always going to be a baseline number of full-time equivalent employees. So if you didn't open until 2020, it's going to be those employees during the period of the January 1st through February 29th that you were actually open. So if you're only open 1 week during there, it'd be those full-time equivalents during that week. So there's always going to be a baseline of 0. Because again, you had to be in business by February 15th to get the money. So if you didn't have employees, by that point, and I don't know how you would have had some, I don't know how you would have gotten along. We back up and talked about the payroll cost. Again, I want to remind you it's payroll, so it's W-2 employees. Anybody you're paying with a 1099 as a contractor does not count in any of these calculations. So if you've, maybe you've got a marketing person that is, works for themselves and does, 10 hours a week with you and 10 hours with somebody else and works with somebody else, and you're paying them a 1099, you can't count them. They don't count as an employee because they're not an employee, and none of their costs that you're paying them count because they're not an employee. And they don't meet one of the other costs of rent, utilities, that. So again, we're looking at employees on payroll. The other thing is, especially with the full-time equivalents, if you use a payroll service for your payroll, they've already got this information. They already can produce the reports for you to calculate your full-time equivalents under these rules. So if you're using Paychecks or ADP or one of the payroll processors, they're going to already have this information and be able to give you the documentation you're going to need for forgiveness, as well as to let you know, oh, okay, during these first two test periods, here are your full-time equivalents, so then you know what you have to meet going forward. And then they would produce those records for you. So another good reason to kind of have a payroll professional doing your payrolls, because they can provide these. If you're doing your own payroll and you're using, QuickBooks payroll or something, a lot of them are coming up with these reports that you'd be able to print. It's just going to put more of the onus on you that it's calculating it correctly. The payroll service is going to be able to verify that those are your correct numbers under their calculations. All right, so as we transition into the next one, we said, okay, here's what all counts. So now how do I get forgiveness? You've told me all the rules. You've told me how to do all the calculations. What do I do? So on May 15th, the Treasury released a form, schedules, and instructions. It's SBE form number 3508. So I think it's 12 pages long, all the form and instructions, as well as it lists the documentation that you're going to submit with this application, as well as a group of documentation that you're going to have to hold and have available if you're questioned. And it's relatively straightforward. It's, if we talk about payroll, it's those payroll ledgers for those pay periods we talked about in the covered period. It's copies of your payroll tax returns for those periods. For rent, it's going to be a copy of the lease agreement. It's going to be a copy of the canceled checks and proof of payment. So they're going to want the check and the bank statement to show when it cleared that it was within that period. Or if you're doing a bank transfer or bank payment, then showing it's through there. If you're paying by credit card, it's going to want the credit card statement to show when that credit card payment was made. So it's a lot of those documentations. The SBE does allow the bank to use a forgiveness form of their own if they want. So what I've advised people to do is contact who your PPP loan is with and have them send you. Most of them have already maybe sent you a link to the form. They're probably using this, but then you can kind of look at that instruction page to say, what documents am I going to need, and go ahead and start collecting those now, because the process is that as soon as possible after the end of your covered period, so again, that 8 weeks, and if we're using the alternative covered period for payroll, the end of that payroll period, we're going to want to submit this form and these documents to the bank, because then the bank has up to 30 days to approve the forgiveness application. So Rebecca, if you jump ahead to the next one, the lender has 60 days from you submitting those documents from a completed application. So the application and what's required to be submitted, they've got 60 days from when that's complete to approve the forgiveness amount. Once that amount is approved, the SBA then has 90 days from the date of the bank's approval to finalize the forgiveness. So that gives them that 90 days to say, oh, this is one we're going to randomly pick to look at, or, we're not so sure about this one. We want to look at it a little further. So again, the bank's going to do it first, get everything together, and then say, okay, we've approved this for this much of forgiveness. It's going to go to the SBA for the final approval. So you're looking at there from the date you fully submit everything, you're roughly looking at 5 months later. So if we're in July, now we're at the end of the year, so now we're okay, November, December, even into January for this to finally have been approved. And we kind of want it closed out as soon as possible so that we know if there's any issue, we're getting it handled and we're done with it. So the last thing I have is just a few reminders there that they've come out with. So when they first put this loan process forward, they said, oh, if you're forgiven, it's not going to be taxable income. You're not going to pay tax on forgiveness. The problem is how they worded it. So immediately people thought, okay, well, this is tax-free money. I don't have to worry about it. They've since clarified it that we don't pay tax on the amount that's forgiven, but we do not get to count those costs as tax deductible items. So if I'm getting, again, I think I used $100,000 of loan that was forgiven, those $100,000 of costs that I used to make up that forgiveness, I don't get to deduct again. So if it was, $80,000 worth of salaries, I'm going to reduce my tax deduction of salaries by the $80,000. So we're not getting to me, the difference is I didn't really pay that. I used this money to pay that. So it kind of cancels out income versus expense anyway. So we're not any worse off from it. But again, I think a lot of people latched on to how they worded it wasn't tax-free and thought they were still going to get to deduct expenses. So for now, if you say, oh, okay, well, we've got to make sure that if you're looking at, tax payments and projections, that you're counting that somehow, whether it's the forgiveness or you're netting out those expenses, but that's going to maybe cause an increased tax bill come tax time. So as the business owner, you kind of want to be prepared for that. So you say, well, Joe, what happens if I don't get forgiveness on part of it? Because I failed one of those tests and part of it's not forgiven. Or I couldn't spend all the money and I've got money left over. We've got two options. We pay it back. So when we go in and they say, okay, we've approved your forgiveness application, Joe, for $80,000, you borrowed 100, then I could say, okay, here's the other 20 back. I didn't use it. I don't need it. I don't want it. Or it really converts when we signed up to get the money as the employer, you basically signed the loan agreement. So this is a loan. What's not forgiven, it's already set up as a loan. It's a 1% annual interest rate. it's payable within 2 years. And it's payable 2 years from the date you received it. So we've got that issue where you say, oh, okay, well, geez, I used it for, I had to buy new goods to sell. So I ended up using some of it for that. Well, I don't get forgiveness for it. Now I can sell those goods and then use that money to pay it back just like I would another loan. So it's not, there's no additional process to go through of, okay, now I can't pay it back. How do I pay it back? I got to sign a loan. It's already set up. It's already done. What doesn't get approval automatically is accruing interest to be paid back. And then the last point there, if you were in my earlier talk, you're like, oh, hey, we get all these payroll credits because we've kept our employees on the payroll. Once we get loan forgiveness, we don't qualify for any more of those payroll credits. So if we're, deferring our Social Security and Medicare payments from from the employer share, even though the employer share of payroll taxes don't count for forgiveness, the fact that we've used the forgiveness for the other piece, we can't use this benefit anymore. If we have been deferring the taxes, once we get forgiveness, we have to stop. We don't have to, whatever's been deferred falls under the old rules. Any new accruing taxes would be paid, have to be paid on our normal payroll deposit period. So one thing, if it's a relatively small loan that's going to be forgiven, or the forgiveness piece is relatively small, you may want to look at, is it worth not applying for forgiveness and maintaining our payroll credits instead of getting the forgiveness on the loan? So that's definitely something you'd want to look at. I'm going to just look through the questions here that were submitted to make sure we answered all of them. Rebecca, you can go to the last slide, which is my contact information. If there's something where you're like, oh, I don't, or thinking about it later and say, oh, I'm looking at this, I'm not sure, or I can't understand the note I wrote, feel free to give me a call or shoot me an email to say, here's my question. I'm a little unsure, or I don't know what to ask my accountant, or my accountant's telling me something different. Can I get a second opinion? I'll be glad to kind of talk about it to make sure we've got that. I want to back up here to one question that was submitted that kind of talks about these payroll periods, because I think that is a very different and complicated concept. So the question was, funding started on April 19th, a Sunday, and normal day was Friday the 24th. And the first payroll was run under the PPP. Can the clock start on the 24th versus the 19th? So again, I think they're saying they got their funding on April 19th. The first payroll that started on or after the 19th was the 24th. So could they count the 24th? So yes, if for payroll cost only, so payroll, health insurance, retirement contributions, state unemployment, those costs you could go from starting your 8 weeks on April 24th and going 8 weeks forward. Your rent and utilities and interest would count from the date of funding, even though payroll's on this period. So you'd have two different periods. You'd have a period of April 19th, the date of funding, for 8 weeks for the other costs. You'd have the April 24th for 8 weeks for the payroll related costs. So that one, you would have two different ones. We can't, once we elect the alternative method, it's only for the payroll. The other costs are always under the covered. Again, I think we talked about it being the 8 weeks. Okay, so there's a question, operating with 9 part-time 1099 folks. Again, even though if they're all 9 or 1099s, then there are no employees. None of those 1099s would count. And the theory under all this is that any 1099 is at least a sole proprietorship on their own and would have been eligible based on their net income, so that they're not going to let you count them as well. So again, any other of these costs, whether it's 1099, people that are working for you, whether it's, if you need, in order to open my restaurant, I got to go buy some new food, none of that counts. Now, the other thing I didn't mention in here is that there's no requirement that these costs be segregated or these funds be segregated. So, a lot of people are saying, oh, you have to put this money in a separate bank account, and then you only pay for your eligible cost out of that bank account. And you've got to switch over your payroll so that it comes out of that bank account. And none of that's true. None of that's supported. That may be a best practice. But if you switch over your payroll, when they take out the payroll, they're taking out the employer share of taxes, which is ineligible anyway. So you still got an eligible cost coming out if you do that. So what we've been advising people is keep everything like you normally would keep it. And then when you run the payroll, if those for your covered period, you go through and you say, okay, here's what counts for forgiveness. So now I'm going to transfer that amount from my fund that has the PPP money in it into my operating account. And then you've kind of got to double check that you're using the money like it's supposed to be used. So if your intent is I'm only using that money for costs that are going to be eligible, then you don't have to get checks and pay it out of there. You can just transfer that money as you go into there. Again, if you say, hey, for cash flow, I need to pay my vendors, and this is the only cash I have, and you're using that to pay the vendors to get them, so that you can reopen, then that's allowed. However, it's not going to be allowed for forgiveness, and now you're on the hook. So what the caution there is that you don't only use that and you don't bring back any of your employees. You don't pay, saying, oh, landlord said I don't have to pay rent, so I'm not paying rent for the next couple of months. And then you've used that money somewhere else. Then they can come back because your intent for this money was to use it on these costs. And again, it's not allowed to not use it on the other costs, but as long as you're using other money to pay it. So you might say, oh, I use that so I can buy food for the restaurant, and then I open the restaurant, and then all that money that I took in from people eating there has gone and paid the employees. Well, as long as it's in that covered period, that counts, even though you can't trace that that's the dollar you used. So there's no specific tracing. There's no requirement that only goes out to those. But again, a best practice is that you're only using that money for your covered costs so that you know you've got forgiveness. All right, I think that was all the questions that have all been answered. So I hope this was informative and beneficial. Again, it'll be back up there. If anything drastically changes, the chamber will, send out some updates about it. My firm's website's on here. We've got a special tab of COVID-19. You could always go to that and check, and as things change, we will update them there. And if things change drastically, then watch for another webinar coming up from the chamber that we'll do the whole thing over again with the new rules. So
thank you so much, Joe, for the very informative webinar today. Lots of great questions. If you think of a question later on, there's Joe's contact information. You can always email me, rebecca@mountpleasantchamber.org. I'll get the question to Joe. Thank you, Joe Hinske, for your time today. And thank you for those who attended the webinar today and for those who are watching it virtually later on. Thank you again so much, Joe.
Thank you. Have a great day.
Take care, everyone.